So in this video, we are going to look at how to manage emergency fund setup using various options like liquid and hybrid mutual funds. Right. Let me pause for you to read through the disclaimer. Let's continue. So as part of this video, we will look at what is emergency fund, what is my current setup, and how to handle emergencies and the emergency fund calculator I have built. Right. So the emergency fund, why do we need to have an emergency fund, right? I would say that there are like multiple aspects to it. One, like if there is a job loss or the medical emergency, that is what triggers the like usage of the emergency fund, right? And then there is a peace of mind when you know that you are covered for this many number of months and so on. And also it is the core building block of equity investing. So unless you have an emergency fund available to you, starting into a equity journey is too much of a risk, right? So if there is a emergency arise and we don't have an emergency fund, we may end up selling our equity at a loss or when the market is down, right? So how much to keep, right? So we have to plan for let's say 3 to 6 months of expenses. Is at the basic level what we have to do. And if you can go for a longer term like 12 months, that would be even better, right? And for me, I feel 12 months is more comfortable, knowing that I'm covered for a year to run through the expenses or to cover a larger emergency, medical emergency that's happening. That makes it much like better. And on the comfort and opportunity cost, right? So the lesser you have the months, you may feel okay, so will I be covered sufficiently or not, right? But if you have a larger month, we may end up putting this money into a lower performing or not as higher as an equity, right? So lower yielding but more stable kind of an assets is what we will look at. So where do we keep these, right? So we can keep emergency fund in multiple places. One, we can have just simply have it as a cash, just to ensure that we don't spend that as a regular expense, right? So that's a challenge with cash. Even the bank accounts, if you keep it in a savings account or a FD linked to a savings account, so there is a challenge that we may go and spend it even if there is no, it's not a really an emergency there. So the other options which we can look at is the mutual fund, where we can park our money for emergencies, which can be liquidated in a day or two, kind of a model. And there are like multiple things we can do in mutual funds. There is a debt-based funds where we can go and invest, and there is a hybrid funds where we have arbitrage and conservative hybrid fund and so on, right? So I choose liquid fund and conservative hybrid fund when I originally started on the setting up my emergency funds. So my setup, right? So it's a 12 months coverage across multiple assets, like multiple mutual funds, different categories, both for like immediate liquidity as well as long-term growth, so that I don't have to keep topping up my emergency fund. One setup it's set up for life unless there is an emergency where we have to spend that money and then we have to refill it up. So this is my the current setup, right? So there are 12 months I'm covering, which is using liquid fund, and there are two hybrid funds I have used to set up this originally. And the liquid fund covers 2 months of expenses, and then there is a ICICI potential regular savings fund, and then one Kotak debt hybrid fund which I have picked up. The first one is more like a stable, not that much volatile. The second one is more volatile but higher yielding hybrid fund. And the other one, likely candidate there is this Kotak Arbitrage Fund, given there is some taxation changes and like we can, rather picking a hybrid fund, we can go for even an arbitrage fund. So this is how the liquid funds curve is there, right? How it is, the asset value is, the net asset value of the fund is rising over the uh, days. right? So it's a very smooth curve. The liquid funds are generally like this, where the curve is very smooth. And the yield is usually like double the of money that is there in a savings account and things like that, right? So this is the smoothest curve we have here, right? And if you look at the hybrid funds, they're also going up, but they don't go in a straight line as smooth as the liquid fund. So this is the first one what I'm holding for the 6 months coverage. The second one, if you see, it's even more volatile, right? But the growth is even higher. If you look at this arbitrage fund, the curve here is more smoother compared to hybrid funds, but not as smooth as a liquid fund. So this is also another option where you can look at like to build your emergency fund. Key insights. So I maintain liquidity using the liquid fund because it's covering 2 months of liquidity. Liquid fund can be immediately accessed in a day or so. And then it grows steadily with the compounding returns because I'm also including an hybrid fund into the conservative hybrid fund into the emergency fund. Though people are too conservative and want to not venture into equity for any piece of equity for a emergency fund, right? But emergency doesn't happen every other day, right? So it rarely happens. Hopefully so, right? And and also it keeps pace with the inflation. So this particular setup, as I said, it's a one-time setup. I don't have to keep topping up my emergency fund. Once it's set up for a lifetime unless used. So yeah, as I said, I'm using an hybrid fund, which is giving a moderate risk compared to, let's say, using a liquid or an arbitrage fund, right? And the challenge is here, if I do a setup in a bulk lump sum kind of a setup, and the emergency occurs soon after the setup, and there is a strong market correction, that will lead to drop in the coverage. That's a risk I am taking. I know that well, and people who are more conservative should just look at liquid or arbitrage funds for building your emergency fund, right? And another important factor here is that the post-tax returns vary based on the fund category. So how the liquid funds are taxed and debt funds are taxed, and the arbitrage or the hybrid funds are taxed, right? They are all slightly different and have an impact in choosing the funds, right? So in the emergency fund setup, like I just compared a scenario where, like let's say the monthly expenses is at 85,000, and the fund emergency fund was set up 4 years back, and what would have happened over it, right? So these XARs are my real numbers, what I have seen in my portfolio based on the dates when I invested, and what based on the current latest values, right? And so I'm comparing here five different things. One is liquid fund. If you just keep it in liquid fund, which has a 30% tax rate currently, and the value would have grown from 85,000 to 1 lakh 11,000 after tax rate at a 30% slab, assuming the higher slab, right? So it will come into 1 lakh 3,000 after post tax, right? If you compare that against arbitrage fund has both advantages. It is having more returns, as well as the tax rate is much lower. It is taxed at a long-term capital gains of 12.5%. Uh, this is essentially when it is more than a year, right? So arbitrage fund having a 12.5% is having an advantage, and also the growth is slightly higher, and the tax is lower. So the yield of 85,000 turns into 1 lakh 10,000 in 4 years. When you compare the blended is what is my current setup. So my blended setup, if I am setting it up now, it will all the funds are taxed at 30% slab. So essentially, this is performing marginally better than arbitrage, but not really that great. Primarily due to the taxation, right? So if you see the actual value, it has grown from 85,000, it has gone up to 1 lakh 25,000, whereas arbitrage has only gone up to 1 lakh 13,000. But post-tax return, because this is all debt fund taxed at a tax slab rate, it is the post-tax returns are not that great. If I had gone full into the higher end of the hybrid, right, where it had a much larger yield, it would have grown even larger, right? But the volatility, like how much it goes up and down in the curve, is not really that much suitable for an emergency fund, right? So that's why I'm not that extreme for setting up the emergency fund, right? And if I look at my actual blended setup, because the entire setup was done in 2021-22 time period, which is all before April 23. So there is a taxation rate. It's all treated as a long-term capital gains. So the my current setup, even after the post-tax return, if I go and redeem it for any emergency purposes, it is still much higher. So let's see how I'm planning to handle the emergencies, right? So as part of this, we will see how medical emergency or a job loss kind of a scenario can be handled. So I have detailed the flow with more diagrams and explanations in my earlier video on how I handle the medical flow, end to end, setting up various things. Just to cover it from a medical emergency perspective, from using the emergency fund, right? So this is the approach that's ideal, right? So you have the emergency covered, medical emergency covered using the health insurance policy, either the personal policies or policies coming from the companies and so on, right? So that's covers the major part of the emergency, hopefully, right? And using the credit cards to pay the money in the short run, not worrying about arranging, redeeming, and everything at the point where the emergency is happening, right? We just use the card, have a sufficient limit in it, and you should be able to cover things that's beyond the insurance policy, right? And the next thing is stop the next month's investment, redirect all of them into the credit card expenses that has happened for the emergency. And then if all these things are not enough, then liquidate the liquid fund, go and liquidate as much as required. And if that is not enough, then go and touch the hybrid funds. The idea is that we go and touch the emergency fund later in the chain, not go and anything happens, we just don't go and spend the emergency fund, right? Emergency fund is really for emergency, so it has to be kept in that way. So handling a job loss, so we have to contain all discretionary spending, because reducing the spending can increase the number of months of coverage, and then start redeeming from a liquid fund, and after 2 months, then start redeeming the hybrid funds, right? And the core goal should be like we shouldn't touch other investments, equity investment, and other things. Keep them as is, and we can go and start redeeming all the hybrid funds required as many months it's needed, right? So let's look at rebuilding, right? So we have to, once the emergency is used up, so we have to start that should be the first goal or first step in the investment wealth building journey, right? So once we have used the emergency corpus, we have to go and start refilling the liquid fund portions first, fill it up, and then if we are using an arbitrage fund or an hybrid fund, right? So we have to start rebuilding it. Hybrid fund needs a gradual top up, because the challenges of volatility, the moderate risk is there. But if it's a arbitrage fund is what we are choosing, it can be just loaded up as fast as possible. And always target maintain your target funds, right? Set it up whatever you are comfortable with, right? So we should always, once the emergency fund is used up, that should be the first place where we have to go and put in our money, fill up the emergency corpus, so that it's always there. So this particular tool will help us plan your emergency fund, setting it up, right? So how you want to do, so you can choose around, play around these numbers, and see what is the timeline it's required to set it up. So the given example here says 1 year, 8 months, kind of a timeline to go and cover the emergency fund. So I will share the link in the description. You can, if you are interested, you can go and look at that. So thank you for watching my video. Uh, so let's catch up in the next video. Please share and like the video if you really find this helpful. Thank you.